Yanis Varoufakis, Greece's new finance minister, is on a mission to the capitals of Europe as the country's new Syriza-led government pledges hardline resistance to accepting more bailout funds with onerous penalties. On Monday, Mr Varoufakis arrived in London, having sent a robust message to the international community after meetings in Paris on Sunday. I'm joined by Martin Arnold, the FT's banking editor, to discuss what happens next. Martin, welcome. Mr Varoufakis has struck an interesting tone as he arrives in London, open-necked, shirt hanging out as he meets George Osborne, the UK Chancellor. Is the message as similarly relaxed as that?
Well, it's very confrontational so far from the new Greek government, and the meeting didn't seem to go so well. George Osborne came out warning that the consequences of a confrontation and a failure to reach a deal on Greece's increasingly dire financial situation could have consequences for the whole of Europe. And so I think that there is clearly a need for some cool heads here, and the meetings that have been held in Paris and now in London are hopefully part of building a sensible position where negotiations can be built from there.
Now, the finance minister's also in London to meet investors. Having seen the politicians, he's turning to the markets. We understand that a meeting's been organised by Bank of America, Merrill Lynch and Deutsche Bank for the finance minister to get to start marketing himself and the new Greek government to the investment community. What do you think investors are going to say to him?
Well, at the moment, Greece is pretty much uninvestable for an institutional investor. So I think the investors hope that the Greek government will see sense and that they will sit down and reach a deal with the Troika, the IMF, the ECB and the European Commission, and that they will, two aspects to that deal. One which investors that I've spoken to today think is quite likely, which is on the restructuring of the debt. That's not debt forgiveness, which is what the new Greek government have been talking about, although it's more or less the equivalent thing, but symbolically it's important. They won't write off the debt. What they'll do is extend the maturities out and reduce the interest that's being paid on that debt to make it easier for Greece to manage and to live with. The more important element of it is the structural reforms that the Greek government, the new Greek government, has said that they reject the need to do such serious structural reforms, and they are actually going to undo and unwind some of the structural reforms, such as privatisations, that have been put in place by the prior government. And that's a much tougher element because the German government in particular wants to keep up the pressure on some of the periphery countries to keep this structural reform to improve competitiveness and to improve the fundamental performance of the economies.
Now, of course, caught in the middle of all this are the Greek banks. They're the crucial conduits for money to get into the economy, and depositors have been fleeing, taking money out of those banks, and obviously stock market investors have been pretty frightened as well. We've seen really volatile share prices over the past few days. At one point they were down as much as 40% last week. What is the future for the Greek banks, do you think?
Well, a lot of the hedge funds that poured tens of billions of euros into the four big Greek banks last year will be licking their wounds now. The last week we saw share prices in the Greek banks fall on average about 35% just in 1 week. It's pretty terrifying stuff, as you said, and there are reports now that after Greek deposit holders withdrew about 4 billion euros of cash last month in December. Last month in January, that accelerated to 11 billion euros. There are some reports out there. So that's on a deposit base of about 160, 165 billion euros. So that's a fairly significant reduction of about 10%. So below even, it could even be below 150 billion euros of deposits in the Greek banking system, and that's akin, we're getting close to a run on the banks now.
Yes, and last week we saw as much as $1 billion a day coming out again. So, as you say, probably below 150 billion, which means the banks have to rely increasingly on state-backed money, whether it be directly from the ECB, which they've already kind of topped out, really, or through the mechanism called the ELA, which goes through the Greek central bank.
Yeah, and there is, as you said, a mechanism through the Greek Central Bank, which has got about 50 billion euros of capacity. So that could tide them over for a short to medium term whilst these negotiations get underway. But the investors I've spoken to are confident that, if required, the ECB would step in and fund the Greek banks. The ultimate decision on Grexit, the so-called breakup of the Eurozone, will come down ultimately to politicians, not to central bankers.
And that is a chess game, really, that is ongoing with everybody else stuck in the middle. We'll see how it pans out. Martin, thank you very much.
Sure.